Hello, everybody. This is Brent Foster, the host of the Northbound Wealth Podcast, and this is May 28th, 2024. Let's dive in. Last week's stock performance was mixed following investors' reaction to the Fed's May meeting minutes, while a handful of mega cap tech companies created a buzz with their news. So, market splits. Check this out. Stocks began trading in a narrow band last week. Still, mega cap tech names rallied in anticipation of the Q1 corporate report from a key company that makes semiconductors for artificial intelligence, or AI. That would be NVIDIA. The enthusiasm lifted the NASDAQ to fresh records. Federal Reserve news midweek unsettled investors who reacted to the FOMC meeting notes that stated some Fed officials worried over the lack of progress on inflation. Technology was the sole winning group for the whole week, with all other S&P 500 industry sectors ending in the red. So on the blog, on my website, www.northboundwealth.com, I got wide charts, weekly market insights, major index return summary. The Dow year to date is up 4.43%, up 20.62% for the trailing 1 year number. MSCI EFA index is up 7.74% year to date. 1 year trailing number is 15.14%. Then I've got NASDAQ composite year to date is up 11.82%. It's up 34.28% over the trailing 1 year. S&P 500 year to date is up 11.07%. That's up 29.03% over the trailing 1 year number. So check this out. The Dow over the trailing 5 years, the Dow is up 70.34%. The MSCI EFA index, which again tracks overseas international markets, is up 49.60%. NASDAQ composite over the past 5 years trailing is up 128.7%, and the S&P 500 is up 102.8% over the last 5 years. So stay invested, buy dips long-term, especially if we're in an equity bull market, which I believe we are in. And I think it's going to continue, especially if we start lowering interest rates. I think that only helps. 10-year Treasury note, which we also track as well, closed at 4.46%. And over the past month, that's down from 4.65%, but yet up over the last 3 months of 4.26. And then over the past 1 year ago, it was at 3.73. So sitting here at 4.46 is interesting. And anytime the 10-year gets close to 5, then we tend to have a sell-off. So keep that in mind. I don't think it's going to go higher. I think it's going to oscillate a bit. So bucking the trend, one of the handful of companies bucking the trend last week was NVIDIA. We talked about it a little earlier. The semiconductor maker, the fifth largest company in the S&P 500 by market cap, thanks to their prominent role in AI, reported that its Q1 sales tripled from a year ago. The company also announced a 10-to-1 stock split. The news pushed the market cap to over $2 trillion. So welcome to the exclusive club, NVIDIA. The companies mentioned are informational purposes only and should not be considered solicitation for the purchase, sale, of any securities. So to some on Wall Street, NVIDIA is the bellwether for the AI industry. By one estimate, the entire AI market is nearly $300 billion for this year, more than 3 times the market size of $95 billion just 3 years ago. By 2030, that estimate may reach $1.8 trillion. Remember that forecasts rely on assumptions and may undergo revisions over time. Financial, economic, political, and regulatory issues may cause the actual results to differ from expectations expressed in the forecast. This week, key economic data: Tuesday, consumer confidence, Case-Shiller Home Price Index. The Fed official Loretta Mester speaks. On Wednesday, we got the Beige Book, Survey of Business Uncertainty. The Fed official John Williams speaks for the first time during the week. Thursday, GDP, jobless claims, international trading goods, pending home sales. Fed official John Williams speaks again. Friday, personal income and outlays. And the Fed official Raphael Bostic speaks. And notable companies reporting earnings this week: Wednesday, Salesforce and Allegiant Technologies and Hewlett-Packard. Thursday, Costco, Dell Technologies, and Dollar General. I'm going to be paying attention to Costco quite a bit. It'll kind of share with the world what middle market is doing and what the guidance is there. All right. So Employees versus independent contractor, classifying those who work for you appropriate. That's the tax tip of the week. Classifying workers as independent contractors or employees is essential for several tax reasons. The basis for this classification has two primary considerations: control and relationship. Control refers to how much of the person's work you control. This encompasses the completed work, its execution, and whether you control the financial aspects of the person's job. In this manner, control means both behavioral and financial control. Another critical factor is the relationship between the employer and the worker. How both parties perceive this relationship can guide you in determining the worker's status. Some factors that influence relationships include the following: written contacts that describe the relationship the parties intend to create, whether the business provides the worker with an employee type benefits such as insurance, a pension plan, vacation, or sick pay, the permanency of the relationship, the extent to which services performed by the worker are a pivotal aspect of the company's regular business, and the extent to which the worker has unreimbursed business expenses. Classifying your workers is essential because independent contractors and employees face different tax needs and implications. And again, this information is not intended to be a substitute for specific individualized tax advice. We suggest that you discuss your specific tax issues with a qualified tax professional. And this tip was adapted from irs.gov. On to the next segment. We've got a good show for you today. The housing market saw an uptick in activity last week as mortgage rates fell to a 7-week low. Here are some key points investors should note. The average 30-year fixed mortgage rate decreased from 7.01% from 7.08% in the previous week. The rate dip revived refinance demand, with applications up 7% week over week and 21% higher than a year ago. However, purchase applications for new homes fell 1% as buyers continue grappling with low inventory and affordability issues. While most existing homeowners still have lower rates locked in, even the modest decreases can motivate some to refinance and take advantage of savings. This temporary refinance revival could indicate a turning point for real estate investors if rates continue trending down and ease home buyer gridlock. What's your take on the mortgage refinance revival? Do you see it as a potential leading indicator of a broader housing market shifts? You can check out the article on my socials and on CNBC. There's a nice article out there that I posted to that. And so speaks to more detail in regards to the housing market and mortgage loan market. Hello, everyone. This is the Technical Analysis Spotlight. But first, what I'd like to say is happy birthday to my son. He would have turned 9 today, but he went to heaven in 2015, and just thinking and reflecting on him today. All right, let's dive in. So what I've done here is I've pulled up stockcharts.com. Love stockcharts.com. I use a lot of their technical analysis tools and insights. And through Charles Schwab, what I do is I look at ThinkPipes. It's the TD Ameritrade platform that's available for institutional traders like myself. And so I will be pulling that up here in the near future as I transition from their legacy product, the Street Smart Edge, over at Schwab to TD's product, which is obviously Schwab bought TD, so it's all the same now. But thank you, Charles Schwab and Stock Charts. Let's take a look at some of my technical analysis indicators. I've got about 15 of them that I've developed over time. And what I see is the New York Stock Exchange. So $ NYSI, the McKellen Summation Index, ratio adjusted. I've got multiple studies here, full stochastics on both. And then I've got price as well of the NYSE. I like the NYSE because it's broad and you can get a good reading on it. But my number 3 indicator is pointing down. The oscillator is heading down. We should probably see some continuation of that as we top out in the equity markets here in the near term. Looks like the number 4 indicator as of May 24th is heading up still, but it's probably going to flatten out, peak out, and then kind of sell off. So after we get a nice melt up, it's actually really good for the market to consolidate, to actually trade sideways or kind of trail off a little bit, maybe even sell off a little bit. That's a natural oscillation of markets. And without that, there would be a lot of pain. If markets just went straight up and to the right, there'd be a lot of pain on those what would need to be massive corrections and crashes. And so I'm glad that we have a periodic way to correct the market and trade sideways over time, consolidate before moving higher again in the next leg up. So we are in a super cycle that should last through 2030, and we might get a bear market in there in between. But that bear market, if it holds key technical levels, key trading levels, then it would just be a great buying opportunity or for long investors trying to deploy cash out of what are yielding 5 to 5.5% Treasury notes or T-bills, and it's really nice to see that. That's nice to have a lever there to pull in portfolios, and then the equity markets give us an opportunity. Then we could sell the Treasuries and buy the equity markets, or if the equity markets are up like they are now, now's a good time to trim and then buy some Treasuries and hang on to some of those gains. So there's some rebalancing going on in portfolios, and as there well should be. And so if you have questions on portfolio management, well, you can always give us a call. Northbound Wealth Management, 317-399-1107. So let's see here. We've got the S&P 500 trading at 5306, which was a price target on many strategist calls for the year across the major Wall Street banks. And then you've got the 200-day moving average at 4761, and the market's trading at 5306. So we've really gapped up. And the 50-day moving average is trading at 5176. So we've really had an impulse move to the upside, and we broke out of that end of year 21 before 2022 high, which was right there back at around that 4900 range. And so now 5306, a new trading range. I would not be surprised if the S&P got to 6,000 this year and just kind of blew everybody away. And a lot is kind of hinging on the election, but also economic data. If inflation continues to trend down, the Fed lowers rates, then you could see that move higher. So stay tuned for all of that. I think there's some opportunities out there in individual equities. NVIDIA, like we talked about, is stock splits are the thing. I mean, I think in summation, it's a good thing that the stocks do continue to split, and NVIDIA doing a 10-1 is really good. Chipotle is doing a 50-1 stock split, and there's going to be others. Apple recently did a massive buyback. Buybacks are a big deal. Says a lot about what insiders believe about the stock, and then also it's a return back to shareholders and building their equity up. So I think all in all, the equity markets are bullish, and it would be good to get some sort of consolidation over the next, say, 4 to 8 weeks over the summer, and then we'll see how the election shakes out in the fall turn. And by the way, wasn't that the most awesome Indy 500 finish, that last lap? That was amazing. If anyone didn't get to see it, you gotta check out social media or just go out and Google and watch the film of that. It was really, really cool to see a finish like that after a long rain delay, but it was a really fun Indy 500. Let's see the NASDAQ. I'm pulling up a daily chart of it. The NASDAQ is again at all-time highs, 17,019 is where it's trading. 50-day moving averages at 16,225. The 200-day is all the way down at 14,871. And boy, since last November when we were trading around 12,008, that would have been a great buying opportunity in the tech space, because you're literally looking at a 5,000 plus move to the upside, and just one bit of a correction from that overhead resistance around 16,600 back in April, and we gapped down 15,200 before an absolute impulse move, and NVIDIA being the catalyst to that, from that 15,002 level to 17,019. And so technology continues to lead, despite what a lot of people fear. It continues to power on, and the tech segment is impressive, and you almost have to own it. If you don't own it, you might just be stuck on the sideline watching a lot of wealth creation happen. All right, I'm going to cover the VIX, and I'm looking at the VIX, and the VIX is like the fear index, fear gauge. what I do in stock charts, I put in $VIX, volatility index, new methodology, and I have an advanced decline line, and I get to look at that as well as price and some Bollinger Bands and 200-day moving average, 50-day moving average, 20-day moving average, 10-day moving average. And so I'm looking at the VIX itself, and man, we're trading, what are we at, 12.88? So 12.88 is where it's at. Usually the VIX trading below 15 kind of being like right in the middle or wheelhouse. We had a spike in the VIX all the way up to 22 back in April, and then basically down since. So it just shows you that a lot of the fear came out of the market and people got bullish, and it turned really quick. Last week I talked about the sentiment indicator with the American Association of Individual Investors, or AAII, and it showed basically just that. A lot of people are still bullish, and the majority of portfolios are sitting at basically 70-30, 70% stocks, 30% bond allocation, and then cash, obviously. So maybe part of that bond allocation is cash. And so people are exposed to equities and risk-based assets, and the appetite is there to continue to do so as people save in their 401ks and their retirement plans and stuff like that. And so we'll continue to monitor the risks there with the market. And let's see, we covered the NASDAQ, covered New York Stock Exchange, the S&P 500, and then the Dow. The Dow hit 40,000. And that's the transports, and that's exciting news. I think kind of like, what was it, Josh Brown was saying, that he believes that the Dow will be at 100,000 in his lifetime. Or I believe that. I mean, if you just do basic 7% to 10% compounding over the next, say, 20 to 30 years, you easily see that the equity markets will get up there to those levels, and that would be a lot of fun to watch and to witness. So it's probably a wise move on pullbacks if you have cash to deploy. And if it meets your goals and objectives, look at the stock market as an opportunity to build your wealth. Okay, bullish percent indicator. Looks like we're sitting at 65.2% of the street's bullish. Anytime when I look at this indicator, we get a big drop down to, say, 25, 10, or 25. So when everybody gets bearish, that's when you should get bullish. When you guys pull up a chart of this, which is $BPSPX, S&P 500 bullish percent index, that's always a good one to take a peek at. So we covered the VIX as well. So let's talk about the dollar. The dollar is trading at 104.60, that's a strong dollar relative to some of these other currencies. So your dollar is going to go a long way. Swiss francs trading at 97.53. Let's see here. The last thing that I'll cover is the CBOE equity put call ratio. I like to plug this in. The CBOE's total put call ratio includes indexed options. So like think S&P 500, NASDAQ, the Qs, Dow, and stuff like that, and equity options. It's a popular indicator for market sentiment. A high put call ratio suggests that the market is overly bearish and stocks might rebound. A low put call ratio suggests that market exuberance could result in a sharp fall. So where are we? Well, when I pull up that particular indicator, so that is $CPCE, $CPCE. It certainly looks like we are not at peak exuberance. So there's kind of a middle ground of a ratio of 0.70. We're currently at 0.67, and we were down to 0.55. And that would be kind of like a peak exuberant level. Just in April, when the market did sell off some, we were up as high as 1.15. So what that means is when we get these spikes, that means portfolio managers and traders are putting protection on in anticipation of a sell-off, and then it can turn. That ratio can drop. Like literally within a few days, it went from 1.15 in April down to under 0.60. And it may not seem like a lot, but in this world of tracking, it is a lot. And if you look at it on a chart, you'll see that. And we're currently at 0.67. So it's heading back up. That means people are putting more protection on potentially ahead of maybe a correction. And so we're kind of like right in this middle ground where the average is at 0.70.
Welcome to the Northbound Wealth
We'll see
Podcast.
over the coming weeks
All opinions
where that
expressed by
goes,
me,
and if you
my
see a big
co-hosts,
spike,
or
that
my
means
guests are
people are getting
solely our
more
own
and more
opinions
bearish.
and do not reflect the
Or
opinions
you
of
could see
Northbound
that
Wealth
even
Management.
that protection
This
come
podcast
off,
is for informational and
people get
educational
even more
purposes
aggressive
only
and
and is
think that
not
the equity
intended as
markets have more
personalized
room
recommendations
to
or
run.
fiduciary advice.
So
It is not
that
intended
concludes
to
the
provide
technical
and
analysis
should not be
spotlight. I hope
relied
you learned a
upon
little
for
bit of
any
something from
investment,
it,
accounting,
and
legal,
there'll be more
and
in the
tax
future.
advice, or as a solicitation.
Enjoy the rest of the
offer
week.
or buy
We'll talk
any
to you
securities.
next time.
Clients
This
of
is Brent
Northbound Wealth
Foster signing
Management
off. The
may
Northbound
maintain
Wealth
positions
Podcast.
in the
Thanks.
securities discussed in this podcast.